there is a framework for thinking about digital assets where I look at this. We have talked a little bit about this in terms of cryptocurrencies, Bitcoin, so store of value, settlement, stable, private coin, CBDC. What is a CBDC? Okay, that's great. We expanded. What is it?
Currency, basically a kind of cryptocurrency issued by the central bank.
So how can it be cryptocurrency? Because remember this, okay, but remember we use the word cryptocurrency, which is backed by crypto-economic systems, is a centralized issue token backed by a crypto-economic system. Is it? No, it's not. Sovereign. So you're basically a digital fiat. You're tokenizing the whole thing, right? Give me an example of store of value.
Gold, store of value.
Yeah, gold is right.
Gold, Bitcoin.
Bitcoin, store of value. What else? What else reminds you of store of value today?
Currency, gold.
He said gold.
Real estate.
Real estate, diamonds. What's the settlement instrument?
Equity.
What's the settlement instrument?
Checks, like Paytm.
Currency settlement is check is not. Check is just instruction to pay. So you know every payment has a clearing and settlement option. So once you write a check, which by the way we still do, which the whole world makes fun of us, like you still write checks. Like, yes, we do. We write checks. We have important legacy. But I don't think anyone in India writes checks anymore, do they? Oh, good. So we have something in common. This is great. But the rest of the world doesn't write checks anymore, right? So the question is this, which I think you should understand if you're devising this for the enterprises. The clearing and settlement step. So when you request to pay or you make a payment, a few things happen behind the scenes. They check you, they check the other guy for KYC purposes. They check if you have an account, if you have enough money. They check if they have an account and they have the right to accept your money. And that's a clearing process. So they say, okay, all this looks good. Now we can send money. Well, money never leaves, right? There's no money going on the wire yet. It's just the instruction, and they have liquidity on both sides, and they transfer the money in your account, and it's done. At the end of the day, central banks reconcile themselves at the master ledger level, which is at RBI level. Say, bank, HDFC owns ICI so much, so all those things transfer, and they all bubble up. They net those functions and move the money at a higher level. That's how these things work today. So that process takes T+1, T+2, T+3 in some cases, and the more time it takes, it's great for the banks. Because now they have more liquid cash that they can lend overnight rates, which is what banks do between themselves, and they make money from it, or they lend it to other people. What happens with stablecoins or a tokenized settlement instrument? Instant settlement. What's the problem with that? It's great for us. You get the money right away, even though with existing UPI and what you do with it, there's a myth of you getting the money right away. You do. You get the money right away as an individual. But what happens in crypto space? What does that change? Shreyas, I expect you to answer this question. This is your favorite. What happens when you have settled using a crypto asset? What is the challenge by using a crypto settlement instrument? Liquidity. That's right. That's exactly what it is. It's liquidity. It's basically the banks have to. That was the. Did you actually hear the question? Just liquidity. Yeah, good guy. It is liquidity. At the end of the day, banks have to adjust to that model because banks have liquidity management system. They have asset like it's a massive thing, and oftentimes they rely upon this cushion of 1 or 2 days to adjust their payments, outgoing payments, incoming payments. Suddenly here we are. So that's one problem with it. What's other problem with settlement instrument? Interest bearing. So right now banks, the entire system relies upon you depositing. They're creating fractional reserve. They deposit. So they're the credit engines of our society. You getting a house loan or a car loan or whatever. If you rely upon these tokenized instruments, what then really happens in that case? So some of the things to consider, especially for if you're working, which is my challenge when we work with regulated financial institution. So all this is all good when you're doing a complete crypto and disruptive use cases and wallets and movement of tokens and everything else. It's great. But if you're working with a bank, it's no longer a simple element of let me just digitize this thing and move the money across. It's a little bit more involved than that. What's the stablecoin? We discussed a lot about this yesterday. What's a stablecoin?
Tokens where we spec to the fiat currency.
So what's the difference between stablecoin and CBDC?
CBDC is issued by the government, while stablecoins are issued by private entities.
That's right, who are backing it up. How many types of stablecoins do you have?
2 types. 3 types. 3 types.
Okay, what are the 3 types?
Algorithm and
Currency.
Collateral backed, so that means it's backed by collateral, which is cash collateral, or what they call HQLAs, high quality liquid assets, behind the scenes. Value on chain, make or die. So there's no bank behind the scenes. Somehow you're valuing this through some over collateralization of some asset, and this represents a dollar based on the dollar value of the collateral that you have. And the third is algorithm. The term for that is synerage, which is a French term. It's a long spell. I can't spell it on my own. I have to rely on spell check on that one. But that's synerage model, and that basically is the algorithmic element, which is what synerage is the term that the banks use for the cost of printing money and distributing money. The difference between doing that is called the synerage, which in places like Zimbabwe and Venezuela, it's negative. It costs them more to print money than money's worth. So you don't want to get in that whole. So the whole idea there is that you have algo or algorithmic stablecoins. I have a much more intellectual question for you. Which one of these 3 you think makes sense?
collateral.
Okay, that is an obvious answer. That's a trap. Why?
Because ultimately, if all fails, we feel that collateral, because it's collateral.
Tether didn't have collateral. Tether didn't have the 1-to-1 ratio. That's a liquidity risk.
But which is why a lot of questions are also being asked about what Tether is doing, right?
Exactly.
Yeah, exactly. So, which means that unless you're going for high quality liquid assets, which is cash or cash equivalents, government bonds, for example, or short-term treasury, which is money market accounts, which means so there's a cost of issuing stablecoins. USDC or Tether or whatever, they issue stablecoins, and if I'm not making any money and I'm locking my assets, I still have to do audit, I still have to do all this cost. So what gives? That has been the obvious answer. For me, this is Nitin's perspective and Masari's perspective. Masari is a research entity, that we think the stablecoin in the crypto world, algorithmic stablecoin in the crypto world should have much more profound impact than collateral backed. Collateral backed is a regulatory checkbox that we need it today because we need to be able to bring liquidity from the traditional finance to crypto finance. But when we do that, you're also bringing the same plague that's been infecting the traditional finance to our world, the crypto world, which is fine in short term because we do need liquidity. We do need participation, and if participation cannot be in terms of applying compute, being creators economy, and doing all these things, then we do need liquidity. We need money to come in, so the people who are creating can go about buying computers and buying these elements around it. But on the long run, if this industry has to sustain itself, as we are building this parallel financial infrastructure, it has to rely upon a stable, price-stable currency in this ecosystem. And I think that the only hope we have in building this is this is where the innovation comes into play, is how do you devise an algorithmic stablecoin that provides price stability. So if you have economists in the room, and if you have technologists in the room, this is a perfect mix of those two together, because that will be a killer application. And there are Frax and Fei protocol. Fei actually failed miserably, but they're still at it, which to me, I have to go back and look at their model in terms of how do they maintain that price stability.
This collateral backed again fuses this the probably faced with the real fiat world
Yeah.
into the digital.
Yeah, so if global macro sort of seeps into this whole thing, inflation seeps into this whole thing, value of money seeps into the crypto world, suddenly now, because we measure Bitcoin in dollars, you see the fluctuation of it. But Bitcoin is a Bitcoin. If you divorce it from dollar, it'll have its own valuation mechanism, or X Satoshis or whatever.
But inherently, stablecoins basically means that it's an interlinking of the fiat world and the crypto world.
Yes, it's a digitization it's the ability for us to tokenize the fiat world to bring it here, only because we want to encourage the participation from non-participating entities, essentially, yes.
So why is building algorithmic stablecoin difficult? Like you can take data from the collaterals and
Yeah.
uh,
Yes, but data is not perfect in this in our world, and this is where we were talking about. I don't know if you're familiar with the efficient market hypothesis, which is Fama's work, then your Fama and Finch academic paper on this topic, where the whole idea is that if all of us have the same information all the time, then the market reaches an equilibrium where it's hard to do anything like an arbitrage. But I will show you some of the research that I have done for data. Right now, you have 3 tiers of data. And that's going to be the next after this slide. We'll take a short break and I'll show my research in terms of what we have done. You have 3 layers of data. Most data that's available to all of us is from an exchange. But you don't have order book data. So you have this raw sort of data which everybody acts like you go to the chain and people are creating all this kind of model. And then you have the secondary data, you have tertiary data. What ends up happening in case of the Fama's paper, not Finch and Fama, but Fama's original paper, is looking into what are the indicators in the market, any market. Well, in case of equities market, it's freaking everything. It's rain in Indonesia too, because we are so globally linked economies. It's everything that affects to it. So how do you, what we call is remove the noise and listen to signals. So you have to tune this out, and I think we've done some experiment data science to be able to figure out what is the noise, which means that yes, it may rain in Indonesia, but it doesn't affect what I'm looking at. So let me remove this variable and focus on 4 or 5 variables. So we have devised element of the fundamental analysis, which is what market traders all do. We look at technical analysis in crypto, which is RSI and many of the other indexes and transaction volumes and code repository and things. And then you have what we call qualitative analysis. How many developers are behind this? How many people are using it? How many transactions are you processing? Like EOS had no transaction for the longest time, and they were doing what they call wash trading, which is transacting with each other. It's like me and you transacting all the time to increase the volume, but that's not exactly transaction because we aren't doing anything.
Basically, you did feature selection.
Yes, that's a part of feature selection. And so by using those time series, and I have my colleague who knows more than I do, but we've been constantly looking at this whole thing is what are the features do we need to extract? And I have a model that we have used in terms of, I cannot share that because that's our intellectual property, but I'll give you the high level components that we factor in terms of where things are. So infrastructure, again, layer 1, a smart contract layers, interoperability layer. Give me an example of interoperability here. And Karan, you brought a Polkadot can of worms yesterday. I'm going to ask you, besides Polkadot, which is the other interoperability protocol? Wormhole is, it was a product from Jump Trading. It was basically a bridge, network bridging. But you're right, it's not a protocol. It was just a bridge that they had built between Solana and Ether. But so Cosmos is an example of that, or OneChain is another example of interoperability. Scalability and governance. This is interesting, which we will not discuss because it's part of Reg and Comp at some level. But governance is token. Okay, so crypto is quite volatile. It goes up and down. Some economic models, like Ethereum, has 1 token model. Some of them have 2 token models. That you have something of value, but you have a token that gives you governance, the ability for you to vote. And oftentimes, because of the mania around tokens, you find all values go together if a token is tied to, so for example, DAI. DAI should never be a $15 product. It's a governance token. It balances out as to what's been paid out and what's been collateralized. And the difference, the delta between the two is how much of it is over collateralized, because if that goes down, then you have liquidation events. So should governance token be in a token that should appreciate in value? That's the question I have for you.
Should governance token
Be a token that should appreciate in value.
yeah.
You only have, it's a binary answer. It's either yes or no. Okay, so why?
Because if the network becomes more and more popular, more and more people would want to have government rights to them.
Anybody else want to give it a shot?
depends on what the network does.
Wow, that's an amazing answer, man. You can't argue with that answer. You're right. You're absolutely right. But let's say we know what the network does. Should a governance token increase in value, or should appreciate in value with the growth of the network, with everything else? Okay, I disagree with that.
But that leads to more centralization.
Yeah, so look, usually there's no network which only has governance token. You have a network, so the question that I asked yesterday, right? 3 things we should evaluate is what is a digital asset, what's a tokenization technology, what's a token, and what's the asset tokenization technology. Ethereum doesn't have a governance token yet. Ethereum itself is a single token asset which is used for everything. For payments, settlement, even if you do ERC, a gas fee, it's utilities and everything else. There are protocols that have 2 token models. One is purely for governance. So by owning a token, you have a vote. That's all it means. So governance tokens, in my opinion, should never increase in value because all it gives you is the right to vote. And it has no value except that you're staking your original asset by voting for a certain thing. Because you cannot have a 2-token system. This is where economics gets really interesting, that both are of extreme value in a system, which is, why would you have 2 tokens then? How can 2 tokens consistently appreciate in value when one is only meant to decide the operational function of a DAO or of a network, whereas one core asset, which represents the collective value, whether it's fee structure, whatever the case is. And that's my opinion. I'm happy to be corrected here, but.
Then what's the point of even having 2 tokens?
Yeah, so.
Like half one, like an equity or a share.
So oftentimes you collateralize a token, it's yours, but you collateralize it to withdraw money for or borrow money, but the token is still yours. But you still have just because you collateralize, it doesn't absolve you from ownership of the token. But the governance token still gives you the right to own until you sell the token, and then you sell the governance token with it.
But then people who believe in the token would never sell it, never trade that token. Since it does not appreciate.
Yeah, but my point is that again, depending on to Ankit's point, depending on what the network does, is the fact that we have a 2-token model. Usually you have a governance token model which is meant to decide and find the operational elements to say, this is my token that your wallet owns, and you're just going to vote with that token, which means it's only meant for recording your vote. It does nothing but that. Which means that if you're selling an asset, so for every asset that you have, every coin you have a governance token with it. You collateralize your coin, you still have the stake in the network because you still own that. You're simply lending it, the token. If somebody wants to buy it from you, they say, I now want to have the stake in the same network, so give me a governance token with it. So that's one model. The second model is that I'm only going to use this to record my vote, and I will still have the asset which is of value in my system. Do you agree, or? I'll give you an example of where you see governance.
I feel like it's kind of counterproductive, sir. Like to have 2 tokens.
Yeah, but many protocols do. Fair protocol has to.
Like VeChain also has it.
Yeah, that's right.
VeChain has it.
Yeah.
VeChain DAO and
Yeah.
VeChain itself. So like I've seen that, but like it always.
I agree. To me, it's the best single token model. Does everything.
Because that way, like
Yeah.
you're invested in the project and you have the.
Yeah, you have everything else, and Ethereum is going the same. Solana with POS, they all have single token models. Single is simple, but in many cases for algorithmic stablecoins, you may need 2. Like in MakerDAO, you needed 2. One is for collateralized token, and one is for stablecoin that's an issuance model.
So in case identity is solved for, isn't the governance token being redundant? In case identity.
That's a good question. That's a really brilliant question. Yes and no. Like if I had a perfect world, then I think if I had one ID, then I don't need to have governance. But identity basically is tokenizing yourself. So which means that if your identity is identified or is recognized on multiple networks, then it's like me going to a country with a passport. It lets me in, but I really have no stake in the economy till I buy something in the country. So if you end up buying a token, now you have a stake in that economy or in that verse. And with
Can be an attribute to the identity.
it could be attribute to identity, absolutely. So for example, if we solve, this is why I think it is the holy grail of our industry, is if solving identity, suddenly you don't need a lot of this fringe wallets and tokens and everything else because it's tied to one single sort of artifact, which is you. And of course, you can have multi-factor, next thing you know, you're taking a drop of blood every time you have to authenticate yourself for your DNA match. I mean, I'm just kidding, that's too extreme, of course. But the thing is that once you get to that point, I think it becomes a lot more simpler for us to take away a lot of this fringes, a lot of this noise that's in the wallets and governance tokens and likes of the world. Chalo, let's move on. Financial, non-financial utility. This is a framework we look at. Cryptocurrencies, we talked about this in terms of layer one as a digital community. Technology, a permission, unpermissioned. Question for you all, can a permission, okay, who can define permission network? Except you, Bhavya. Who can who can describe a permission network?
Just like it's a private blockchain where parameters are kind of like set before and external parties cannot enter unless and until approved.
Yeah. So can permission network have a token?
Yeah. Yes. DM was supposed to be a permission network.
Quasi-permissioned. So it was meant to be permissioned, but if you look at the white paper, the idea was to start with the consortium, but open it up for anybody to. It never worked out. What are the challenges of having a token and permission network?
You have to issue it personally to every single.
That's right. And that means that you become a centralized entity doing it. And then what are the other challenges?
So for a permission network, could we argue that it's like naturally centralized, right?
Yeah, it's hands down. Absolutely. Which to me, I walked away from that whole thinking about permission networks because one, it's an IT problem. You're using DLT so to me, a permission network solves the issue of moving from asymmetric to a more symmetric information dissemination model. That's all it does. And the challenges in this network, just like we discussed with a few minutes back in terms of what the question that you asked, Shreyas, is Bitcoin's processing capability, the 10% and versus verifiability function. How do you enforce the equitable compute infrastructure that every party brings to the table? So a company could bring inferior infrastructure while there are 4 companies who bring the cutting edge tech. How do you balance that out without a compute equity model? So there's no equity. They don't have equitable contribution to the network, but they all have tokens, which means who values the token and what do you use the token for if all we're doing is chargeback? At the end of the day, it's just chargeback. So I keep questioning that every time it comes up, like in a coin, in a closed networks, what are we really doing with that token? And I think from permission networks, at least I have come to this conviction, I may be wrong, is I don't think closed networks or permission networks can go down the token model. They can certainly go down to a consortium model, which is an entity running it for them, and they all having some model that says bank A is using million transactions, bank B is using 100. So you pay based on your usage, but you have a flat fee to enter. Something like so this is the business models which I was supposed to discuss yesterday, is the build, own, operate, transfer type stuff, where entity builds it, it owns it, operates it, and it simply bills you. Or it owns, operates, and transfers it out to ACH or RBI type entities who are managing it.
Maybe like a proof of stake with number of transactions.
Something of that sort. Yeah, and I think that in that point, the governance model becomes a challenging element. The tokenomics doesn't, because you can always alter it because there are like a dozen of people agreeing to it. Okay. Settlement. I think we discussed this in quite detail. How many of you are familiar with Swift network? What does it do? Yeah, 11,000 banks, and they have, but basically all Swift does is messaging. That's all they do. They just send messages back and forth, right, at the end of the day. And I think what we've been discussing with them, what they've been, and there's all this public information, is can they take their existing messaging model, implode it, and use the same network to be able to use token sort of back and forth, right, instead of using the messaging they have now. So we, at least when our team built Wallwire, we looked in the model where your network should be able to not only move messages, but also move tokens, which means giving a user a choice. So remember, we had this conversation, but when you move into stablecoins, you have a liquidity challenge with banks. So what if banks choose to use messaging because it conforms to the liquidity models, or use a stablecoin to move money as long as the parties are willing to pay for it? There's a cost of processing stablecoins too. So talk about stablecoins. What? It's being recorded, so I'm just going to hold my thoughts. the way I look at it is this: the entire industry is a big experiment that's happening at the moment. I always ask the question, what gives a token its value? And we discussed that yesterday. It's either network effect, because you have amazing tech, and people are attracted towards building stuff. But I always look at a question to say, if a token does only one thing, which is what Stellar and Ripple do, or Stellar has begun to have smart contract now, by the way, which they didn't. So Bitcoin, by the way, doesn't have smart contract, right? All you can do in Bitcoin is move Bitcoin. And you generate more Bitcoin by moving Bitcoin. Taproot tried to bring smart contract layer on top, which is happening, which is basically another layer. Ethereum had the smart contract element. So if a network like XRP and Stellar is meant for payments, then I go back to look into what is the overall addressable market. So payment is a big spectrum. You have security settlement, bank to bank, account to account, business to business, remittances, which is overseas foreign workers, and India and UAE is the largest corridor in the world for money flowing between two countries. Singapore and Philippines are the same. So that entire market is about 600 billion, now it's about $1 trillion. And the cost of that market is 8%. 8% is what they pay as fees, interchange fees, to just send money, which the people who shouldn't be paying are the ones paying the most of it because they are poor to begin with. And they're paying 8 or 10% fee structure behind it. So then I question, to say if it's 8% addressable market, and there are close to 1,000 companies doing cross-border payments for remittances, which is one small segment of the entire payment industry, then what is the worth of all XRPs as a market cap? Is that equitable to the payment stream that you're addressing, which is remittances? And you'll find a disparity between those two numbers. So the question is if that's the case, I think you invoked a good question here for me, is when we're evaluating, I'm looking at what does a token do, what does it give value, what problem it's solving, and what's the address. Some of the NFTs, you have no numbers in addressable market. I have no clue how many people are going to go off a Top Shot or cricket. I used to play for Karnataka State when I was 16. It was a fantastic era of my life. But I don't know what the situation is in India in terms of, because at the time you only had India cricket team. Now you have T20, you have like a billion different opportunities. I don't know where the money is in that space. But for payments, we know. So if the market cap of the entire project is more than the problem it's solving, then to me it becomes a speculative asset. So you simply have to do the math. That's my opinion on that. Just figure out what's the market cap of this, and just take a simple math of 8% of 1 trillion. And if there's a disparity, to me, how do you what's the narrative behind the disparity? Right or wrong, I don't know. That's for you to make a call on that.
So this is a random basic question. So let's say we're transferring Bitcoin from two non-custodial wallets. There's still a transaction fee involved, right?
There is today. It's going to increase after all are mined. Yes.
So eventually, if Bitcoin is
Yes.
limited in nature,
Yes. I know.
we have a cap on the number of transactions that we can do, right? So after a certain number of transactions, there's no more Bitcoin left.
No. Yeah. There's no more Bitcoin. So that's a great question. So you know what it's talking about, right? 21 million. What happens? All of them are mined. So right now, Bitcoin is the cheapest network to transact today on, right? Ethereum is expensive because of all the mucking around they've done with it. But let's say every Bitcoin is mined. And if I want to send a Bitcoin to you, well, if they'll switch to a fee structure. So now I have to pay a fee for transactions. That's how the miners will make money and get paid. What I don't know is that the incentive economic today with Bitcoin is quite high. The last 10,000 Bitcoin is going to go to $1 million. And Bitcoin has 8 decimal places. So you'll have 0.0001 Satoshi, which is 1/8. Let's say in 2030 becomes $1 million, which means that you'll have to go into something like a layer 2 solution to be able to actually have a much more economically feasible transaction processing than rely on direct network itself. That's why I think Stark.
Because it feels like the only way to solve that problem is to not use Bitcoin itself as a transaction.
Yeah, I agree.
It's limited in nature.
I agree.
It's like saying if you're going to buy gold, I'm going to buy gold, I have to pay a little bit of gold.
To get well, yeah.
So like the gold will run out.
Yeah, and I think that's why the layer 2 and Taproot is trying to solve some of that stuff. Layer 2, like Lightning Network has been like Stark, and what tipping has done with this thing is trying to solve that problem is layer 2. Layer 2 eventually, and that's why I think I'm pretty big on Lightning Networks, is that's going to be eventually and that's actually, if you look at the development of those two They're happening in parallel. There's a lot of work happening in Lightning this year. Maybe it's El Salvador, maybe it's, because even El Salvador, it's hard for them to move money. It's about 600 million goes from US to El Salvador every year. It's a very small country. It's a beautiful country, but because of the perceived crime, there's more crime in New York City than El Salvador, by the way. But there's less tourism place. So that's all they have. They have a small country, not a lot of natural resources. And so they're relying on Lightning networks to be able to move money at economical pace and have the infrastructure around it. So Shivo, which is their platform for ATMs and everything else, that's relying on Lightning network to move money. Bitcoin becomes expensive.
Okay, but is it fair to make the price of Bitcoin rise slower because more transactions are not happening in Bitcoin, actual Bitcoin network, and more Bitcoins are not being mined?
Are you saying, is there a deliberate attempt to slow down the transaction?
Slow down the rise in price.
So that's an interesting point. What do you think is the contributing element to rise of price of Bitcoin?
The scarcity of it and the demand for it.
Yeah. I mean, I don't think the transaction volume has anything to do with it. Yeah, it's the store value element of it. It's a new asset class. There is certainly a demand which has gone up from institutional investors, the Michael Saylors of the world and Fidelities of the world who are trying to go, and the ETFs of the world who are trying to, so the demand has gone up. I don't think it has anything to do with the processing capability of Bitcoin, which is a sad part. But I think, to me, okay, barring the global macro elements, what gives Bitcoin its value? Yeah, it's trust. It's a currency of trust. It's got 280,000 blocks. It's taken 10 years worth of energy to protect it. It's sort of an unbreakable system with existing compute capacity. It is quantum proof, believe it or not. The whole notion of having quantum to break Bitcoin is very fluid at the moment. So you have built a trust system over 10 years worth of energy that's gone into conserving and securing it. That's the value of Bitcoin as a purist, that you're paying for that trust, that's unbreakable, can't undo and can't mess it up. Because the day that happens, hook or crook, or 6 years back I did a math, that if you apply NSA's compute capacity, because you have 10 minutes before the next block gets created. You have 10 minutes to change and redo the entire 280,000 blocks, and as you keep adding more blocks, that becomes harder and harder. So within the 10 minutes, if you're not able to change and fix everything, then new block comes and you have to apply the same compute capacity all over again. And it was, at the time, costing $1 trillion to do it in 10 minutes. Energy, computes, which only governments have that kind of compute capacity. By the time, Bitcoin was 84 billion. So there's no incentive for people to go spend $1 trillion when you can just buy all the Bitcoin in the market and still own all of it. So it's a trust currency, and because of the trust, and minus the financial speculation and financial markets asking for it as a store value, everything else, at a technical level, it is the money you're paying because it's been secured of a decade worth of energy that's gone into creating that structure. The resiliency and all the things that we look for in a global system. There's no global system. First of all, most real-time payment systems are localized. SWIFT is like a layer on top that connects them. And then you have banking who are trying to figure this out. But none of these systems are completely resilient. Your RTGS goes down twice a year in India. None of the payment systems in India are completely 100%, even though India has the requirement of having payment access all the time through one of the 3 or 4 sort of what you have. So that's sort of I don't know if that makes sense. Privacy coins, very interesting, very controversial. Monero and Dash, know Dash guys really well. Example of Dash. How many are familiar with cannabis here? Yeah. Ray, how many are really familiar with cannabis? I'm not asking if you smoke pot, guys. I'm just saying that. All right, that's great. We have some raise a show of hands. So I followed. This is a super interesting. This is Dash coin. So this is very contextual in the U.S. Of course, you don't have this problem in Amsterdam, where cannabis is a healthcare issue, and healthcare is regulated by state in the U.S. So the government cannot tell the U.S. about what to do about healthcare because that's a state's agenda. Like state cannot tell the federal government about immigration and banking. Banking is Federal Reserve. So you can see where this is going. Some states have legalized marijuana for health and recreation. It's against the federal law. And so when you do banking for marijuana, it becomes a federal offense. So you can see this dichotomy, right? States are saying it's completely legal, go do what you want to do, have a good time. The federal government say you can't pay for it using a bank. Cash is okay, but cash becomes a problem because it's a lot of cash and no one really deals with cash anymore. So what do you do with it? So I went to Arizona. Arizona has legalized, and it's also interesting. I'm on their. The government has put a blockchain research board. I'm on that board. This comes up all the time. How do we circumvent this? Which is states figuring out this is a banking regulation. How do we deal with this? And no one will touch it because there's no way around it. So Dash Coin came along. So Dash says, hey, we will accept token at a point of sale system. So they built a point of sale system with QR code and everything else. And you can go to a cannabis, it's called, what's it called again?
A dispensary.
That's right, a dispensary, as you like to put it. Go to a dispensary, and you basically buy your products, and you pay for it. And it's interesting, then I had to follow the money. So from there, I went to Panama. It's a Dash coin, it's a crypto asset. So I went to Panama, I met the exchange, and that goes to an account in an exchange in Panama. Panama, like Ecuador, and like many countries in the world, is US dollar denomination banking system. It's a sovereign nation, but it's US dollar banking denomination. They do have a coin of their own called Balboa, but everything else is in US dollar. It's just a coin that says it's our monetary system, leave us alone. And the pegging is one Balboa to $1. But they only mint Balboas. Everything else is all the greenbacks that you have. So you go back there and they have this thing where you exchange Dash, they convert the Dash into USD, into a banking system, and do a banking transfer from Panama to the United States. All of it is completely legal. But the kicker, interchange fees. You want to guess how much is the fees for a dispensary to do this? Okay. How much is the fees for MasterCard and Visa? 2, 4, 5%, depending on where you are. And you said for this interchange was how much? 10%. And no one's complaining. Now, we all complain, or at least the merchants who are, they complain about Visa, MasterCard fees, that, hey, it's a big drain for 3 to 4%, everything else. None of the dispensaries complain because they are able to get money in real time. All this is happening in real time. And these are all disparate systems. To me, it is fascinating to go, and I traveled from Arizona. I went to, it's literally what you see in movies. I traveled to Panama. I'm like, okay, what are you guys doing here? Then the banking system and moved it, and that's just a common thing. Because Panama, as you know, has Panama Canal. So all the banks in the world are there, because for most trade finance locations like Singapore, and they have to be there to process transactions as the goods move through the canal. So just an interesting context from this privacy coin with Dash.